Okay, hello everybody, and welcome to Investing with IBD, sponsored by Vantage Point. Today is December 23rd, 2020. I'm your host, Arusha Pierce, and we have back on the show Kenny Polcari. Kenny is a managing partner at Case Capital Advisors and the chief market strategist at Slate Stone Wealth. Thanks for being here, Kenny.
Arush, it's always a pleasure. I've been looking forward to this since our last time together.
Absolutely. So on today's podcast, we are going to continue hearing stories from Kenny. I asked him a simple question. Kenny, tell me a little bit about yourself. And what was it? 3-4 hours later, we only got up to 87. So we're going to continue it.
And we
So
started in 1980. It would be one thing if we started in 61 when I was born, but we only started in 1980.
Right. So this is really part two of a ever-going series of Kenny Polcari. And so we'll start off with 1987. Well, we ended with 1987 in the previous episode. We will start after that. But let's go into the current market first. The market is in a confirmed uptrend. Do we have 5 distribution days on the S&P 500, 2 on the NASDAQ? Kenny, what are your thoughts on this market?
Right now, for the next 2 or 3 weeks, I think we're churning. I think it's kind of fully priced at the moment. I think there's a roadblock, potholes or roadblock, a speed bump, whatever you want to call it, in early January with the Georgia Senate race, because I think that could flip the whole conversation. The market will reprice after that fact, but I think up until then, we could see the market actually kind of churning here and move lower. I think we're at the highs. The closing highs for the year. I know we tested, last week we were 36.20, 37.20. But I think around right in here where we closed, I think 3,700 is once again providing a little bit of resistance. And I think there's that lingering concern about what's really going to happen in January.
So now let me ask you this, because you've been doing this for a number of decades now. One of the greatest markets that you've ever seen in 2020. Is this the best, one of the strongest markets, or were there a few others that were even stronger that you remember?
Well, listen, it certainly was a strong market in 2020, based on considering everything that's happened. It really is a remarkable year the way it ended up. But, it's also a remarkable year because of all the other stuff that's going on, right? The fiscal stimulus, the monetary stimulus, the low rates, the negative rates, the promise of keeping rates at zero for another 3 years is all adding. I would say to you, one of the other greatest bull markets was the birth, and we did talk about this the last time, is 1982. The birth of that bull market was when rates were 21%. And they were coming down. And that was, a 20-year, 25-year bull market, really from 1982 till 2000.
Well, 2000, yeah.
Yeah, 2000, when the dot-com bubble, when we had the bubble and then the burst.
Right.
But we can talk about that because that's about where we are now, right? After we leave 1987, we come into the early 90s. And the early 90s, I'll let you go. Did you want to ask your question?
No, could go. I think that's okay. That was a great segue.
Okay. We came into the early 90s. Now, here's what people have to understand too about the early 90s we were smack in the middle of this technology boom because the world was changing rapidly. Technology was advancing across a range of industries, but one of them specifically that made so much sense to me and us and financial services was technology was also beginning to really cut its way into financial services. Number one. Number two, we had Y2K coming up. And for the listeners who were not around during Y2K is simply that year 2000. And around that, if you remember, all the concern about what was going to happen when the world went from 12/31/99 to 1100. And that whole conversation about, the world was going to come to a standstill and the planes were going to fall out of the sky and GPSs were going to fail. No water, no electricity. Right? That's what it was going to be.
Right.
And so the 90s was all about upgrading and new technology and new formatting and people around the world. This wasn't an American event. It was a global event. And that anyone around the world that had a computer, that had Microsoft software and all the others, they all had to either upgrade or figure out how to fix it, how that computer was going to take it through the turn of the century, because that was the concern, right? So in the 90s, Oh my God, the market was just crazy, but tech names were out of control. If you were a tech investor in the 90s, it was like Candyland every day. I mean, it was a beautiful time in the market, right?
Well, let's talk about like the early 90s, right? So, well, first, well, you mentioned Microsoft. So Microsoft went public 87, maybe late 87, early
Right,
88,
right,
around that time.
right.
And then it went on its next great run in the early 90s, which was after the first Iraq war, right? So you
Right,
had the first Iraq war, the market comes in,
right.
and then all those tech stocks, right when the market goes back into a confirmed uptrend, and Bill O'Neill and all the portfolio managers talk about the 1991 story about how all these great tech stocks set up and they get stuck off.
Yep.
Talk about like 1991, the first Iraq War, some of your memories of that at the exchange.
Well, so it was really interesting, because the exchange was such a focus, um, in 90s. I mean, it was when you thought of capitalism in this country, you always thought of the New York Stock Exchange. When you thought about
Yes.
IPOs, all that, you always thought about the New York Stock Exchange. And what was interesting is a lot of the tech names all traded on Nasdaq. They didn't there wasn't a lot of tech on the New York Stock. I mean, there is, but Nasdaq became and is today, or they'd like to tell you, the tech capital, right? All these tech
Mhm.
names go to Nasdaq. Although I will recently, the New York Stock Exchange is making its own way there. But one way or the other, in the 90s, um, it wasn't so much, right? And so a
Yep.
lot that was happening in tech was happening really on the Nasdaq stocks that I did
Okay.
not trade during that
That
time.
makes sense.
Yet,
Yep.
yet, during that first war, what it was like to actually be on the floor, the level of angst, the level of concern, not only in the markets but really for the country, and what did this mean? Because this was really, I mean, listen, I was a child during Vietnam. I mean, I was 7 or 8 years old, so I have no real recollection of Vietnam other than what I've read and studied and seen.
Yeah.
But the Iraq War and that whole Gulf War turning into the Iraq War, that was really that was really the war that all of a sudden we were at war. Now it wasn't a world war, it wasn't right, but it wasn't like it wasn't as apparently as ugly or nasty as Vietnam was. I mean, Vietnam,
Right.
the stories are horrendous, right?
Right.
But it was still
But
a
there, but
war.
there was a, but there was a definite concern. I remember
There
at
was
that.
an absolute concern. There was
Right.
an
Because.
absolute concern out
Yep.
of the Middle East, out of some of those
Yep.
countries in the Middle East. Was it going to be
Yep.
retaliation? And so there was this high level of alert, and you could feel it every day when you came downtown in New York City, kind of walk around. There was just a sense of heaviness, not on the market, but in the air.
Yeah.
Right, there was this.
Yep.
There was a sense here we were going to war, and weapons of mass destruction, and you start to think of what does that really mean, and what would happen if something happened here in the United States, New York City, with 8 million people in it, the subway system, the trains, the bridges and the tunnels. I mean,
Right.
when you think about the devastation and the damage and they could do to the country just by hitting one big city like New York City.
Right.
It was a time of certainly angst and anxiety for a lot of people. And being on the floor, was also a little bit at times a little bit anxious, because if you really wanted to hurt America, we were sitting there waving our arms going, hello, look at us, right? And
Yeah.
that was actually the fear in 1987, that after
Yes.
that, right? Remember I said
Right.
that,
Right.
is that after they hit the two buildings, they immediately evacuated us because they thought we were next. And
Yep.
and so there was always that kind of fear. But for the most part, the war went on and the country was very, concerned. The markets continued to churn.
Yep.
And we clearly made it through. But it wasn't like they didn't change anything at the exchange in terms of how you got in or how you got out. Certainly there were controls around who could come on the floor, who couldn't, that kind
Yeah.
of thing. And after the crash of 87,
Mhm.
it became, the New York Stock Exchange became synonymous with well, it was always synonymous with capitalism, but suddenly there was this interest in it, right? Remember, Dick
Yeah.
Grasso then started. There was talk about how he brought the media to the floor of the New York Stock Exchange to almost pull the veil back, right, so that everybody
That's
could see it, and that
Yeah.
he brought the New York Stock Exchange and investing and the capital markets right into everybody's household. They could turn on the TV, they could be in the thick of the trading, and it was very exciting. That didn't happen. That was a conversation that started in the early 90s that actually didn't happen until 1997, I think it was, late
Okay.
97 with Maria Bartiromo. We can get
Yes,
to that.
that's
We can get to that in a minute. But
Yep.
during, you know, the Gulf War in the early 90s, there was that kind of mixed message, right? Because on the one hand, the market was doing very well after the crash of 87. Technology was starting to change the world, but yet there was this lingering concern about, you know, the country was at war.
Mhm.
Anyway,
and then obviously it was a surprise to a lot how quickly it ended. Markets take off.
The markets took off. The markets were the markets are very supportive in terms of, you know, being at war, and you know, every day there'd be another headline, and as we made headway and as we won, you know, the market would celebrate those wins, right?
Yes.
And so yes, the market took off, and that as soon as it ended, there was a sense of relief. And then the market continued to soar. But look, a lot of that was also driven around advances in technology. Now, technology was helping the defense industry, it was helping, you know, the financial industry, it was helping the airline industry, it was technology was helping everybody, right? It was changing the face of the world. But the other thing that people have to start to understand is, remember, we were still operating the largest capital markets out of the three major market centers, Asia, Europe, and the US. Is that we, the biggest capital markets out of those three, we're still operating in a single location with 5,500 people, pen to paper, eighths of a dollar, screaming and yelling at each other, when the rest of the world had already gone electronic, right? Europe had done it in the late 80s. And actually, when they did, they called theirs the Big Bang too. Their floor disappeared overnight.
Wow.
When Europe went to when the UK started in the UK, right? When they went electronic, the flows over, they disappeared overnight, and everything, all trading moved upstairs, and it all started trading electronically, and we were still trading pen to paper. Right. And so we had to prepare. And I think I hit on this last week. We had to prepare for the turn of the century. But there was this other huge problem at the turn of the century, this thing called Y2K and the computer systems and all that stuff. And the New York Stock Exchange was certainly right in the thick of that, because computers were delivering order flow to the exchange. Computers were, you know, printing the trades to the tape. The computer was delivering executed messages back and forth. And so therefore there was this massive push to have to participate in this technology upgrade that was happening. But there was also this massive push to renovate the markets, right? The markets go through a major renovation about every 25 or 30 years, because the world changes, technology changes, things change, which then necessitates an upgrade, right? And so now it was time. But the problem was, we needed to rewrite the country, the industry needed to rewrite every rule set that had been written in the 33 and 34 acts, the SEC 33 and 34 acts, that dictated how trading would get done, how you represented the order, the increment of trading, all those things, all those rule sets, and how the markets interacted. They all had to be rewritten for what would be a technology-based environment where computers were going to start to do a lot of the work that the humans did, right? And so you couldn't just do that overnight. They had to rewrite the rule sets. Then they had to put the rule sets out to the industry. The industry, you know, had 3 months to comment. Then they had to go back, and then the SEC and everyone else had 3 months to go through the notes, and then figure it all out, and then put more comments out. And so not only was it going back and forth, but it was the advances in technology that were happening so quickly that every time you thought you had it down right, the technology changed, and you had to go back and start to rewrite it. And so behind the scenes, as we were trading every day face-to-face, pen to paper, people were working behind the scenes to rewrite the rule set, to try to create an automated system that would work in that rule set so that everybody could participate. And so that the goal was, we were going to convert post the turn of the century. So we were going to trade pen to paper right up through the turn of the century. And there was kind of a method to that madness, because look, if the world fell apart the way that it was predicted to, we were actually still trading pen to paper. So if the computers failed on January 2nd, 2000, guess what? The US capital markets could still function, because we had a phone, we had a pen and paper, we had people that could trade back and forth. Europe and Asia wouldn't have been able to do that, because their systems were all automated. And so if anyone was going to get hosed, it was going to be Europe and Asia if the technology failed. In fact, we went through the turn of the century, the technology did not fail.
Yeah.
And so that's when the push came on the United States. Okay, guys, now it's time to push. Now it's time to convert, the quote unquote antiquated system and step into the 21st century, because now we're actually in the 21st century. And so now we have to actually step into it with the US capital markets and make it, as advanced and as efficient as the other markets.
So Kenny, before we get into the 21st century, let's go over to 1997.
Yeah.
Talk a little bit about that. And you left the exchange for a little bit, right?
I did, but I didn't leave until 2000, and I left in 2006.
Okay, but in 1997, there was WorldCom, MCI.
There was a Russian ruble crisis. There was a bunch of stuff that was just happening. There was the collapse of long-term capital, which was another thing, right? And when you think about the long-term capital event, if I remember correctly, I think it was a $3 billion event, right? That was the potential impact. It was like this $3 billion, when you talk about 1997, was like the way they talk about, 5 trillion today. Oh, it's only 5 trillion. But 3 billion though was this massive number, right?
Right.
And so it was the Russian ruble crisis. It was the MCI WorldCom deal. It was all these kind of outside events that all happened. It was like the perfect storm. They were all happening at the same time. And it caused anxiety, not only in the markets, it caused anxiety amongst investors. And the long-term capital thing actually shook the markets at the time to its core, because it was its web. It had all the big investment banks tied in, right? They had deals with all the big investment banks, and who's lending who capital and who's lending who money, and how's this okay? But yet it was like the web that just went out. And so when long-term capital started to fail, or when it failed, there was this ripple effect that just spun out through the industry. And if you remember correctly, they got all the the seven families together: Merrill, J.P. Morgan, Bear Stearns, Lehman, because they all had to rescue.
Right.
All those guys had to rescue, partly because they had all jumped in. They were ready to lend money as best they could, because everyone wanted to do business with long-term capital. Everybody wanted to be the banker. Everybody wanted, and so it was great until it wasn't.
Yes.
So the industry said, "Okay, guys, step up to the fucking plate now and fix this."
Yep.
And so if you remember, this is where it comes back to bite Dick Fuld from Lehman Brothers in the ass, because he didn't want to. Everybody else stepped up.
Oh, that's really interesting.
And that's why when the world fell apart in 2007 and Lehman Brothers was going down the drain,
no one came to help him.
They didn't come to help him.
That is fascinating.
But that came back. That was 10 years later. It bit Dick Fuld in the ass and really was the demise of Lehman Brothers. Because if you remember correctly, Hank Paulson, who was Treasury Secretary at the time, basically said, not helping him. Because when the industry, and
Hank Paulson was at Goldman at that time.
It was at Goldman. Right. When the industry needed all the investment banks to come to the rescue,
right,
and try to solve this long-term capital problem that they actually helped create, he was the only one that refused to do it. All the other ones did it. And so, and there was a lot of back and forth at the time about that, about Dick Fuld and Lehman Brothers, but it was like one of those things. They just put it back here in the closet and they left it there. And then 10 years later, it exposed its ugly head. But we can get to that part of the story.
That's amazing. Yeah. So this is a perfect time to take a break. The market is in an uptrend. Stock continue to act well, and maybe we have that Santa Claus rally again. Let's take a quick break. But when we return, we're going to talk more about this. We've gone to 1997 now, so we're making some good progress. We're going to get into the 2000s. We'll get 2008, and we'll learn more from Kenny Polcari. We'll be back. Stock market have you nervous? With the hope for a COVID vaccine and a shifting political landscape, it's virtually impossible to guess what will happen. But with Vantage Point, you don't have to. Visit www.freestockcoaching.com and find out how Vantage Point's AI technology can forecast stock market trends up to 3 days in advance with incredible accuracy. Vantage Point's patented technology analyzes huge quantities of global data in seconds. Stop guessing. Check out www.freestockcoaching.com and experience Vantage Point for free. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Kenny Polcari is our guest on Investing with IBD, sponsored by Vantage Point. Okay, Kenny, let's continue with the story. And so that was a really fascinating point that you made about Dick Fuld there. Let's go a little bit ahead. After long-term capital, the markets recovered. Now the markets get going again. And you know, it was a few years after the irrational exuberance comment too. Let's go into 1999. Tell us some of your stories from that, your recollections at that point.
Oh my God. 1999, remember, was the beginning of the dot-com bubble, which had ended in flames in, 2000 and 2001, what you call the dot-com bubble and burst. But, the internet now had suddenly really taken off and come into the market. People were able to, people on the street, taxi drivers, people could access the markets through their computer on this thing called the internet, right?
Yes.
And so it was fascinating the way the world really changed at that point, right? I mean, listen, it started to change earlier, but it was in the late 90s where all of a sudden it became easier for people to access the financial markets, access their accounts at Fidelity or whatever, right? This whole phenomenon of the dot-com, right, made huge headway, not only in the investing space, but in the markets. Very much kind of like, it feels very, on some levels, it feels as elevated as it does today with some of these unicorns that come to the market. The difference today between then and today is actually these companies that do come to the market, even though they quote unquote say they're not earning any money, they are real businesses. They do earn money, but they have huge growth expenses. So therefore, quote unquote, they don't earn money, right? But in 1999, when pets.com or rubmyback.com or whatever came to the market, they were just ideas. They had no revenues, right?
All they had to do was put a .com.
All they had to do was put a .com at the end of it. And all of a sudden it was like one of these unicorn names where people were just crazed. And I think the most amazing part, again, these were all new NASDAQ names because none of these stocks qualified to be listed at New York, number one.
Interesting.
And number two, because they were too small, they had no earnings. They didn't meet any of the requirements to come be listed on the New York Stock Exchange. So NASDAQ opened the door and said, "Oh, come here. We're great. We'll have you." Right? Okay, great. Wonderful. And so they all went to NASDAQ, which was fine. So they didn't actually happen on the floor of the New York Stock Exchange. So people should understand that. And at the time, in 1999, I couldn't trade stocks on NASDAQ from the New York Stock Exchange. I couldn't even trade NASDAQ stocks because I was worked on the New York Stock Exchange. We only traded stocks on the New York Stock Exchange. So that's all I could do. If I had a client that wanted to buy Microsoft, he had to call a broker upstairs. Couldn't call anyone on the floor. He had to call a broker who was upstairs to execute that order.
Wow.
Anyway, but all these stocks would come to the market. I'd never forget. I used to scratch my head and go, what am I missing? Because very much like today, where an investment bank, whether it be Goldman or Morgan or whoever it was, would bring one of these .com names to the market, pets.com, toys.com, whatever it was.
Yeah.
The same way. Now think about, just because this happened just recently, think about what happened 2 weeks ago with DoorDash and Airbnb. Now, they both came to the market. Goldman and Morgan Stanley brought those deals. They were the lead underwriters in those deals. They came to the market. Here's a perfect example. The Goldman investment bankers who have a responsibility to go out and build a book. They have the responsibility to go out and sell the deal. They have a responsibility to go out and access interest from institutional investors. They're not talking about mom and pop. They're talking about the Fidelity Growth Fund or the American Funds Growth Fund or XYZ, whatever it is, right? All these institutional asset managers. It is their job to go out there, not only sell the deal, but then to help build the book. What's your interest? You're the portfolio manager at the Fidelity Growth Fund. What's your interest? Okay, a lot depends on price, right? Well, what are you pricing it at? I see the deal. What's the price? Okay, if the price is $50, I'll buy 100,000 shares. If the price is $40, I'll buy 1 million shares. If the price is $30, I'll buy 2 million. But if the price is 60, I only want 500,000 shares, right? And so you build the book. And
That's
so the
interesting. Yep.
job of the investment banker is to go around and assess the interest and build the book.
Mhm.
So Airbnb is the perfect example. And I laughed about it. I wrote about it in my note. I put it even on Twitter the next day. They tell management at Airbnb on Wednesday night at 6:00, we've made this assessment, we've come up with it. Airbnb is worth $68 a share. Now, I understand you leave a little bit on the table so everybody looks good, but a little bit might be 10%. So maybe you leave $6 on the table.
Okay.
So you get that on IPO day, you get a little bit of excitement. The stock pops a little bit. Nobody's embarrassed. Everybody's kind of right.
Yep.
And so they tell the management at 6:00 on Wednesday night, it's worth $68 a share. Here are all the buyers. Here we allocated all the money, and Fidelity said they're going to be a buyer in the aftermarket, and American Cap, because these guys say I want 5 million shares, they get allocated 2 million. So you assume they've got 3 million shares worth of interest behind,
Right.
but that's at $60,
Yeah.
right, or $68.
Yeah.
So what happens is the other thing that they do and that they've done, and they did the same thing in 1999 with the dot-coms, is that, it would be the chatter, the talk. I mean, they talk it up. They talk, it's the next greatest thing, blah, 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 right?
Mhm.
The difference is today, people use Airbnb, so they know what that product is. People use DoorDash. They know what the product is. In 1999, Pets.com. What the hell did I do with Pets.com or Toys.com? There's not an experience there, right? Yet, because it had this .com name to it, and because these big investment bankers went out and sold the story, the Wall Street Journal, and everyone ran stories about it. It was the greatest thing in the world. And there was all of a sudden you could go to this thing called the internet. You could actually look it up and you could read about it, right?
Yep.
In real time.
Yes.
And so it was nuts. And so they would, Pets.com would price. Morgan Stanley says that thing's worth $12. Okay, it's worth $12. On Wednesday night, they say it's worth $12. On Thursday, when it goes to trade at the NASDAQ stock market, it opens at 150. And it trades up to 300. It trades back to 200, up to 300 again, and then it closes at 180. And everyone goes, oh my God, how great was that? You're sitting there scratching your head going, what just happened, right? And the same thing happened with toys.com. And the same thing happened with, notebook.com and whatever you want. Anything that had a .com next to it. It was absolutely crazy. It was so crazy that you'd take a cab in New York City and the cab driver would be telling you how he made so much money trading XYZ.com. Okay, dude, if you made so much money trading XYZ.com, what are you driving a friggin' taxi for?
Right. And there is a famous saying there when your taxi cab driver's telling you stock tips, sell everything, right?
And that's the top of the market. And so what ended up happening was that went on for a good 7 or 8 months, into 2000.
Mm-hmm.
And then that whole world started to collapse because those companies had no business. They had no revenues. They had nothing, right?
Well, they were measuring it on eyeballs at that point, right?
Correct. And so all of a sudden it started to, in 2000, it started to come under some pressure, and people started pulling their pants down and saying, what is really going on here?
Yeah.
Let me take a real hard look at this. And suddenly people realized that these stocks weren't really worth anything. And so they all started to come undone. But then what ended up happening was they all traded on NASDAQ. They were considered technology names, blah, blah, blah. Technology, quote unquote, was coming under pressure. And what happened? NASDAQ lost, 50 or 55% of its value. I mean, it went from
maybe
50,
more than that. Yeah.
It was actually more than that. Yeah. That's right. It was more than that.
I want like 70% or something. Yeah.
Because I think the high in early 2000 was like 5,500,
something like
and
that.
the lows was 17 and change.
Yeah,
and the low was 17 and change in mid 2001, I believe. I can look back on the chart and tell you, but it didn't happen overnight. It happened over like a year.
Right.
But if you look at the chart on the NASDAQ, it just goes like this, right? I think you're right. It lost about 70% of its value.
Well, I mean, and it was a 2.5 year bear market too.
Correct.
Right.
Correct. Right. It started kind of in late 99. It went through 2000 into 2001. Right.
Yeah.
And then finally, I think it was before 9/11 for sure that it kind of found a base and it kind of churned there for a little bit. The markets was still, we were still in a bear market. Listen, the Dow sold off too, but not nearly. I think the Dow
because as you mentioned before, all those stocks were in the NASDAQ. And actually what I can do is I'll pull it up here on the screen.
Yeah, and they weren't New York Stock Exchange stocks, but the country was in a recession.
Yeah.
And so, so the market came under pressure as a result of the country being in recession, and company earnings, all that stuff. Typically, what you would envision. Which one is that? The Nasdaq. Oh, that's a
This is the
Nasdaq.
Nasdaq.
Right.
This is a monthly chart from 5100,
Yeah.
5132 down to 1108.
Okay, 1108.
So
And
yeah, I
how
mean,
much time is that?
and that was 2.5 years. So
Right.
it topped in March of 2000
Yeah.
and bottom in 2002. October 2002. So yeah, 2.5
Oh,
years.
October 2000. Okay, so it was after
Yeah.
even it went through 9/11.
It
It
was
still
long.
continued.
Yeah. Because because like it was, we were already in the correction at that point before 9/11,
Yeah.
and then it accelerated downwards.
Yeah.
We had a little bit of a rally, I think, shortly after that. Yeah. So here's 9/11 around at this point.
Yeah.
Then we took out that, and honestly, I think once we took out the lows after 2001, that's when everyone kind of gave up.
Yeah. Yeah, and names in Nasdaq, and if you were a Nasdaq trader, those days were dark for you, right? It was tough.
Yes,
it wasn't
yes.
As much as it was tough on the New York. It was different because the New York, we were trading, quote unquote blue chips. You got American Telephone and IBM and Bank of America and JP Morgan. I mean, those weren't pets.com those days, right?
Yeah, no, the New York Composite handled it a lot better because it didn't go up nearly as much. So
right.
Yeah.
Right. And so what was the low? The high was what on the New York?
On the New York Composite, it was 72.02.
Right.
And it went down to a low of 44.07.
44. Can you put the Dow up there? Because that's like that's like almost a 50% move. That's like a 42% move, isn't it?
Yeah. Here's the Dow, 11,750 down to 71.97.
Right. So that's like the Dow was like a 35% move.
Right.
But the Nasdaq was to double that. The Nasdaq was a 70% move, right?
Yeah.
And so that took us through that took us into 2001. The country was still kind of in a recession. Right. And then we know what happened. I mean, the world in the summer of 2001, the markets, the global markets were kind of churning and they were struggling having to time. And then September 11th was the events that really kind of changed the world at that moment.
Right. And obviously that was a significant moment in everyone's lives here. What we want to do is, instead of focusing on that in this episode, we'll have Kenny come back around September 11th next year to go, because Kenny has just an amazing story about his experience there that I really want to give it its own kind of due, and really have kind of a special episode on that, because his story was incredible. He gave it for our master's program. What was it, Kenny? Like 5-6 years ago, you came and spoke to the attendees there, and it was just stunning. It was just so incredible. So yeah, I told Kenny, let's hope we'll separate that story, because it's so phenomenal and just so impactful that to have its own episode. So we'll save it for next year on that.
So we'll save it, but what you have to understand, what the people should understand, is as a result of that event.
Yes.
Not only did the world change, but the country suddenly looked at each other and said, "What are we doing?" Up till this point, we had used technology to become efficient, right? Mm-hmm. All of a sudden, I could get this computer to do your job and his job and her job. So I come into work, I'd say, "Okay, you're out. You put the computer in its place," and it was efficiency, right? Yes. And I was people get laid off. I was, saving money. I was more efficient, all that stuff, and that was happening not only in industries around the country, but it was certainly happening in the financial services sector, right? And so then after 9/11 happened, what it revealed was the vulnerability of the country, because here we were, the largest capital market in the world out of the 3 major market centers, and we were operating our capital markets in a single location at 11 Wall Street, in a physical building with 5,500 of the same people every single day. And that was the vulnerability.
Yeah.
Because when that event happened and the exchange shut down, there was no backup plan to say, okay, well, we need to start trading stocks tomorrow. Yes, this event happened. Trust me, I lived it, so I'm not being cavalier in this at all. But you'll understand why now, because remember, the market was closed for 6 days. Mm-hmm. And so it started to create panic. in the country. Because just think about this one. If you were somebody who'd worked your whole life and you put money away, and you had a $2 or $3 or $4 million portfolio in a retirement account, an investment account, invested in US stocks. And on Monday, it's worth $3 million. And then this event happens on Tuesday. And then the market doesn't open Tuesday, doesn't open Wednesday, doesn't open Thursday. And you keep calling your broker going, hello, knock, knock, knock. I want to sell my stocks because I'm nervous now. And you know what happens when people get nervous? They want cash in the bank. They don't want to own a piece of paper that says I own Coca-Cola or I own GE. They don't want that. Right. And so when the investors would call up their brokers and say, I want to sell my stocks, the answer was, I can't because the exchange isn't open. And so people get nervous. And then take that and multiply it around the world. Investors in Asia, the same way we take money and I go invest in Asia, I go invest in Europe. Asian investors come to America, they invest in US stocks. European investors come to America, they trade in US stocks. And so when those investors call their broker in Asia and Singapore and Australia and Europe and whatever, I want to sell my US stocks, and they're told they can't sell them.
Wow.
Then who starts to get nervous? The whole world starts to get nervous, right?
Yep.
And so the country knew immediately that we needed to get the exchange up. As difficult as it was, and trust me, it was difficult. And we can get into that in the next show that you want to dedicate.
Definitely.
What it revealed was the vulnerability. And so then the focus on technology became, holy shit, we need to use technology to create security and stability first, and then efficiency. We had it all wrong. We were using it to create efficiency. No one cared about security and stability because this event had never happened. And then after the event happened, everyone went, holy shit. And so it immediately flipped technology on its head. So now you started to say, okay, how do we use technology to create security and stability? And how you do that is what we have today. So today we have 11 exchanges that exist in this country. The New York Stock Exchange is the only physical exchange. The rest of them are like NASDAQ. They are virtual. They trade in the cloud. The servers that run them are located all over the country. They're not located in downtown Manhattan, because if they were, you blow up downtown Manhattan, you bring the place to its knees again.
Yes.
And so now they're located in Colorado, Massachusetts, and Florida, and California. They'd have to blow up the whole country to bring the system to its knees. And if they blow up the whole country, who gives a shit where Bank of America is trading? We got a much bigger problem, right? And so if they blow up the New York Stock Exchange, is it a tragedy? Of course it's a tragedy. And I would like to think that for that one day, trading in this country would halt, but the next day, trading in this country would come back, which is what you could not do in 9/11. Right. Because there was no way to do it. Today, if they blow up the exchange, tomorrow, all the electronic exchanges that trade in the cloud that didn't get blown up are perfectly capable. And look, you know how I can prove that that's true? Because look what happened during COVID in the spring when the New York Stock Exchange closed down for 8 weeks. There was not a single person at the New York Stock Exchange, yet the markets functioned. If you didn't know it, you would never have known it.
Yeah.
Because stocks traded, they didn't fall out of bed. They weren't erratic. They weren't, right? Stocks traded without the New York Stock Exchange. And so,
COVID's a great example of a number of your stories here is first stocks traded. No one had to be there physically to do it. And also stocks halted a number of times in the day.
Correct.
When there was a lot of panic setting in.
Correct.
So the lessons learned from 87 really came back to help at this time.
The lessons, the remember I told you those, like the circuit breakers were born out of the event of 1987.
Right.
And so they have been used. They haven't been used a lot. But when they have been used, it's been to kind of slow a panic for whatever reason, or in fact, a mistake, right? Mm-hmm. Like the flash crash of 87. That was a mistake, but the circuit breakers kicked in. Well, what happened with the circuit breakers kicked in, and we could talk about because we're going to get to that, because that's actually a very interesting part of the story about how the circuit breakers kicked in at the New York Stock Exchange, yet those same circuit breakers did not apply to the electronic venues because the tech guys in those electronic venues, they didn't want to play by the human rules. But we'll get to that in a minute, because that's actually another great story in the history of the financial markets during my career. But anyway.
Perfect. Well, and that's a perfect place to take a break. So we'll take a break. We'll continue with stories with Kenny Polcari after this. So stay tuned. Tired of reading about other people getting rich in the stock market? Today is your day. Vantage Point's artificial intelligence has predicted countless market reversals, helping traders weather any storm up to 3 days in advance. Visit www.freestockcoaching.com and find out how their AI automatically recognizes global market patterns well ahead of the news to help you pick the best trade. Go to www.freestockcoaching.com to join a free live training session today. Don't delay, save your seat now. We are back with Kenny Polcari on Investing with IBD, sponsored by Vantage Point. Okay, Kenny, so we're in 2001. A lot of technology changes have been taking place, a lot of security. The whole priorities have switched from efficiency to more to security. Let's jump out to 2005, 2006.
So it was 2005 and 2006 when a lot of the changes, besides technology changes, but rule set changes and market structure changes started to take effect. And it was really 2005 and 6 when you saw exchanges around the world start to go public, right? Because the New York Stock Exchange was a private institution up until 2005. And I say it was private institution. It was owned by the members. The members were the people that owned the seats on the New York Stock Exchange. The seat represented the stock in the firm, but it was all private. If you owned a seat, you owned stock in the New York Stock Exchange. But it wasn't, you couldn't publicly trade it like a stock like you can today. But what happened was after not only the events of 9/11 and then technology kind of changed the face of the world, it changed the face of the role that markets, that exchanges were playing in global markets around the world. You started to see European markets go public. You started to see talk of the U.S. markets going public, because then it was going to then change not only the way the markets operated, but then it gave Americans and investors around the world the opportunity and ability to play in the exchange space, right? But in order to do that, the exchanges needed, they couldn't be run in a private institution by 1,300 guys that could never make a decision. They couldn't. They needed to be a publicly traded corporation. So what ended up happening was in 2005, John Thane, if you remember, Dick Grasso had gotten thrown out after 2002. John Thane had come in, from Goldman had come in and orchestrated not only the advances in technology that started to take place even faster on the floor with handheld technology for the brokers and delivery systems and all that, but he also then orchestrated the reverse merger of ARCA and the New York Stock Exchange. I remember ARCA, and maybe your listeners, some may and some may not remember, but ARCA was an early entrant into kind of the electronic trading world, right? As an exchange. And it was very difficult. It was clunky. It didn't work efficiently. People didn't trust it, but yet it was a publicly traded company. It traded on, I think it traded on NASDAQ, certainly didn't trade on New York. And so John Thane saw it as an opportunity. First of all, we did this reverse merger. So now suddenly the New York Stock Exchange got entree into an electronic platform through ARCA, because it was a completely electronic platform. So they got an entree into the electronic space, and they also then took the exchange public. Right. And so if you were somebody that owned a seat on the New York Stock Exchange, which represented the stock in the company, when that event happened in April, you got a check for $6.8 million, of which 350,000 was cash and 6.2 million was in NYSE stock. Wow. Right. The symbol was NYX. And so it came at $62 a share. It traded up to $120 or $128 before the market crashed in 2007. It traded as low as $15, during the crash. And then got taken out ultimately by ICE, which owns it now. ICE is ICE. It's Intercontinental Exchange. It's a publicly traded company on the New York Stock Exchange. They own electronic markets all around the world. They trade every product under the sun. And they came in and they scooped up the New York Stock Exchange for now it's pennies on the dollars, because I think ICE trades at about 120 or 130 bucks now, if I look it up. But one way or the other. But when the exchanges went public, suddenly the world changed again, because now the exchanges had a different master, right? They had shareholders that they were responsible to. They had to have earnings. They had to pull the curtain back and expose their financials. And so therefore, versus when you're a private company, you don't do that, right? You say as much as you want, and the rest you keep a secret. But when you're a publicly traded company, you have to pull the curtain back, and you've got to expose it. So they had a whole new set of masters, which are called shareholders, like all public companies have, and so they have a responsibility in terms of growing the business, in terms of how they're going to use technology, what's the plan, what's the plan for the future, how are you going to grow, why should I buy this stock, why should I play in this space, and so therefore that fueled the next change, or all the changes that were to come at the markets, whether they be the New York Stock Exchange or the CBOE, or any of that. Now, notice it didn't happen as fast as it happened in Europe in terms of the elimination of the floor, but for all intents and purposes, the floors no longer exist in the way that they did, right? The yelling and screaming and the 5,000 people running around, blah, blah, that doesn't exist anymore. It's actually very quiet. If you go down to the floor of the New York Stock Exchange during the day, you hear the hum of the computers. That's what you hear. People can talk, you and I could talk just like this and with no problem. If you would come down there in, 1987, I'd be going, "Hey, Arusha!" And I'd be screaming at you because you'd have to, right?
Right.
Yeah, but you'd have to, because there was so much noise and people screaming and yelling. Today, there's no noise. And listen, CBOE doesn't exist anymore. All the floors in America don't really exist. The buildings are there. The building does represent the New York Stock Exchange, the same way the NASDAQ building in Times Square represents NASDAQ, but there's nobody trading there. There's management that's in the building. And so today, the exchange does have, the exchange is still holding on. It does have a set of market makers on the floor, although that's getting, that keeps getting whittled down because technology once again makes it more efficient, right? The 5,500 people that worked on the floor in 2000 is now down to less than 250 people. Wow. Think about that. Wow. 5,300 jobs got eliminated because of technology and efficiency.
Right.
And so the 5 trading rooms that made up the total floor of the New York Stock Exchange, it was the main room, the garage, the blue room, the extended blue room, and the new room. Those rooms, the only room that exists now is the original main room, which is the room you see when you see on television every day. Is the original room built in 1903 with the 7-story ceiling, and it's all very dramatic. And it's the most spectacular room in all of New York for sure. But it doesn't exist anymore in the way that it did, right? And it was a direct result of not only the technology, advances in technology, but as the exchanges went public. And then there was this push to become, more efficient, more forward thinking. How are we gonna, what's our plan for them? How are we gonna grow this business? Payment for order flow, competition with other venues that were now starting to pop up. Other electronic venues, alternative trading venues.
That's right.
What's the one that also was quite popular?
Bats came out.
No, the one
or Chicago Mercantile Exchange.
No. Oh my God, the one that's right on the tip of my tongue. I'll think about it in a minute. But anyway, so there was all these threats to the New York Stock Exchange because asset managers were being lured away to trade stock in some of the regional exchanges off the New York Stock Exchange, all through these electronic platforms. And as clunky as it was, it started to make sense, right? And we had already converted from, I didn't get into the whole conversion process from in 2000, right? When the exchange started to modernize, in order to modernize and bring in the technology, you had to change from fractions to decimals. Right. And so that took 6 months. Because you couldn't just change 5,000 stocks between NASDAQ and New York, and just on Monday they were trading in fractions, on Tuesday they trading in decimals, because you would go from 16 price points, because we had gone from eighths of a dollar to 16ths of a dollar in the late 90s. We stayed at 16ths of a dollar through the turn of the century, and then we went from 16ths of a dollar to decimals. And when you went to decimals, now there's 99 price points, because there's a penny, 2 pennies, 3 pennies, 99 cents, right? Before, when I first went there in 1980, it was an eighth, a quarter, 3 eighths, 5 3/4, 7 eighths. Then it was a teeny, 2 teenies, 3 teenies, 4 teenies, 5 teenies, 6 teenies, all the way up to 15 teenies. And then it was a penny, 2 pennies, 3 pennies, 4 pennies, all the way up to 99 cents, right?
Yeah.
And so the amount of traffic order flow, noise, right? Because
Yeah.
people could, put a penny bid in, take a penny bid up, put a penny back bid, offer it at 3 cents, take it out, offer it 4 cents, pay 2 cents. I mean, and because they could do it with high speed computers, it wasn't
Yeah.
like someone was sitting there typing on a keyboard. They
Yeah.
just programmed the computer to do it. And so the
Yeah.
amount of message traffic would have overwhelmed the system if all of a sudden you just flipped the switch on Tuesday and said, okay, everyone's trading in decimals. And so we started that conversion process, and we did it by the alphabet, right? So it took stocks A through D, and they converted them from decimals, from fractions to decimals. And so for 6 months, what was really interesting, it was really cool. I mean, I can look back on it now and think about the way it was. But when you think about it, for 6 months, some stocks were trading in decimals, some stocks were trading in fractions, right? And you had to think differently, because when you walked into a stock trading in fractions, it traded very differently than a decimalized stock. The conversations were different. The volumes were different. And so that went on for 6 months, because they'd convert, 4 names at for ABCD. They convert all those stocks on the same day. They'd let it run for 2 or 3 weeks, make sure the system. Then they do E through E, F, G, and H, and then they do I, J, K, L, right? And then and so by the time we did it, it took like 6 months. But when November of 2000 came, we were fully automated, fully decimalized, and that's when all of a sudden they shoved the handheld. They really pushed the handhelds. They said to brokers, now you got to really start to use the handheld technology now, because we're in decimals. And that was the first wave of guys to retire. And the guys that were retiring in 2000 when they pushed the handheld on you were guys who were my age then. I'm 60 now. So the guys that were 60 in 2000, I was only 40. Yeah, I was only 40 then. So I was kind of still in the middle of it, right? I was fine. But the guys that were 60 that had been trading pen to paper, face to face for 30 years, they go, I'm not using this thing. And so there was this natural attrition.
Yeah.
Then as the technology got better and better, then there was this forced attrition, right? Where all of a sudden I got this computer that could do your job. And I'd come in and say, listen, I don't need you anymore. Right. Versus you saying, I don't want to do this anymore. Right.
Yes. Yeah.
And so then, so that takes us up until when Thane took the place public. And then the push got even more severe with technology, because it had to, right? Because there were demands on the management to show growth. How are you going to improve this? How are you going to improve this company now? Right. And it wasn't, the 1,300 members coming up to take a vote. Bullshit. There were no more members after that. Even though today they still call it a seat. Like you say, you talk to a designated, he goes, yeah, I have a seat in the exchange. It's a license, really. It's no longer a seat. Seats are gone, right? It's called a license now. But one way or the other. So that took us to that change.
So you had the change. So now we get into 2007. Obviously, that housing crisis starts to unveil itself.
Well, listen, the housing crisis started to unveil itself, but it was after all those other new acronym type investment vehicles started to fail. CDSs, CMOs,
CDOs, and all
CDOs,
that
right? All these 3-letter acronym, very sexy and fancy investment vehicles, which, by the way, were unregulated. And you can thank Alan Greenspan for that. So if you want my opinion, you can trace the beginning of the financial crisis right to Alan Greenspan. Because when all those products, CDOs and CDSs and CMOs and ABCs and ABSs and all that shit, when they all came, when they were all designed, they were all designed by Wall Street, by the way, at the encouragement of DC, because they all helped to fuel the housing market, right? And they were shifting risk, and they were helping sell mortgages and blah, 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 and all that stuff. And so when they brought it to the Federal Reserve, Alan Greenspan said, no, there's no need to regulate these. They're not stocks. They're investment vehicles, but we don't need to regulate them. They're self-regulated, right? So they were never regulated. And so they spun out of control. And then when the economy started to kind of stumble a little bit, those products started to fail. And when those products started to fail, they started to fail because when the economy started to stumble and people started to lose their jobs and they couldn't pay their mortgages, that's when all those products started to fail, right? And don't forget, it was 1984, 85, 86, when the housing market in this country was just on fire, and they were giving mortgages to people who had No income, no verification. Do you remember those loans? You could just walk into the
The
bank and
ninja
say,
loans.
yeah, I want to buy this house and it's $500,000, but don't ask me if I have a job, but I want the money to buy the house.
Right.
And so they were just handing out the money.
Yeah.
And if you don't believe me, you should watch that movie, The Big Short.
I've watched it.
Okay,
Yeah.
it's actually, they do a very good job of explaining how it all unravels.
I enjoyed that
right?
movie. Yeah.
And so your listeners, they should you should, if you haven't seen it, it's a great movie and it's easy to understand. They actually discuss it in a way that makes it easy for Joe Q public to understand it.
Yeah.
You don't have to be a Harvard educated Ivy League person to understand it. They make it very easy, and it's actually a great movie. I think they did a great job of that. But one way or the other, when that started happening and those products started to fail, and all this exposure, it was insurance companies that were exposed because they bought all these products because they were safe.
Yes.
Right? And that's bullshit.
Yeah.
And so, and we all know what happened then, because then suddenly Bear Stearns Asset Management started to fail. And
Dick Fold, comes back.
And then Lehman started to fail. And that's where it comes out of the closet, and Dick Fold comes out and everybody shoots him.
That's incredible.
I
mean, yeah, because and Dick Fold in the movie The Big Short is one of those central characters.
Yeah.
But they never really touch upon that part, but Hank Paulson's in it, Dick Fold's in it.
Yeah.
And that really brings it full circle.
Well, remember, because Bear Stearns was the first one to go belly up. And if you remember that, and here's the other thing, is that people that worked at Bear Stearns, like Enron was another example.
Yes.
But people that worked at Enron, because Enron was this hot stock in
2001, around that time.
The late 90s into 2000. And so people that worked there, they'd get stock as part of their bonus, they'd get stock as part of their compensation, they'd buy stock out of their paycheck at a discount, just Enron. And then when Enron blew up, those people got wiped out.
Done. Yep.
Wiped out. And so the same thing happened with Bear Stearns. There were people that were so loyal to Bear Stearns, they just had Bear Stearns that when they had the opportunity to diversify, when their options got vested, and we owned so much of this, why these people didn't diversify, but they didn't. And so a bunch of other people got wiped out. Same thing happened in Lehman Brothers.
Yeah.
Because the same thing happened. But when Bear Stearns got taken out, I'll never forget it. When they made that first announcement, I think they got taken out at like the very first. Do you remember the very first JP Morgan announcement? I think they took Bear Stearns out at like $4.
It was something like
was
that,
the headline.
Yeah.
It was, it was down from 130. And I think they talked JP Morgan into buying it, all kinds of backstops, and the government was going to insure them and all that stuff. And I think it was like it might have even been a $2 bid.
Yeah, I want to say it's between 2 or 4.
Yeah,
and that was like around March of 2008. Yeah.
And the place went. Remember, the place went crazy. You can't do that. And so they upped the bid. I think they ended up taking it off at $12 a share, 10 to whatever it was. But that kind of then set the tone for what was then the beginning of the global financial crisis, right?
Yes.
Because then after that event happened, the economy got worse. More people got laid off. People couldn't pay their mortgages. People just left the houses, gave the keys back to the bank. Some didn't do that; just left on the fucking front door and walked away.
Yeah.
And there was this building boom going on in the country that suddenly came to a standstill, and all the financing and all that stuff that went into this building boom all just came to a standstill, and then the markets collapsed, right? And then what ended up happening was people that were trying to sell the CDSs and the ABSs and the CMOs and all the shit that they should have sold, who was going to buy them? There were no bids, and so you couldn't sell them. And so what happened? What happened was asset managers and life insurance companies and people that owned the shit that they couldn't sell.
Yeah.
They panicked. And so what did they sell? They sold what they could. So they hit the sell button on stocks because the New York Stock Exchange is up there every day. You can see prices every single day. They just flash across the tape. You want to sell GE, you hit a little button. You want to sell 100,000 shares of GE, you can sell 100,000 shares in 5 seconds in GE. Bingo, sell. Boom, it's all gone. And your cash is in the bank tomorrow. And so what ended up happening, it happened around the world because this whole U.S. housing crisis, again, it was this web. Mm-hmm. A lot of it by Lehman Brothers, by the way, which was also part of the problem, right? Lehman Brothers was so connected. I mean, they all were, but Lehman Brothers more so, was so connected around the world to asset managers that as it started to fail, it was this ripple effect around the world. And that's why Dick Fuld thought that he was going to get rescued, because he had his web was so thick that he thought they're never going to let me fail. They can't. They're never going to let me fail. And they let him fail.
Yeah. No, yeah, I mean, it was, and probably in many ways they let him fail because he didn't come.
Well, and
to help out.
and listen, and there is, without them ever, there was that innuendo. There was that innuendo, and people would refer to it, but no one was going to come out and say that was the reason.
Right.
But there was, even Hank Paulson, there was those innuendos saying when we needed you, you said no.
Yeah.
And now there's no reason to save you. And you remember how ugly that got. I mean, and then that just, when that happened in September of 2008, that just, sent the markets into a tailspin.
Yeah.
And I'll never forget, every day you'd go to work, and
I mean, how much the Dow was up 700 one day, down 800 the next,
these
right?
wild swings. And at this point, I was off the exchange because I was running the desk at ICAP, which was a big British interdealer broker. And I left the floor to move upstairs to run it from the office, because I had an upstairs trading desk and traded NASDAQ names, and I couldn't manage that from the floor. So I had to leave the floor. So I left the floor in 2006. So I was actually upstairs on the trading desk when 2007, 8, and 9 happened. I went back to the floor in December of 2009 because the whole business, the NASDAQ desk at ICAP got blown up. The business really got blown up. And so we shut it all down, and I went back to the floor to salvage what I could try to salvage. Right.
Yeah.
And then did that, stayed there, and I was there until October of 2012.
Well, Kenny, we'll have to, once again, we've gotten all the way up to 2008, 2009. I think we made some really good progress, but we'll obviously have to have you come back again and continue this story. And as mentioned before, we'll do another episode where we can focus on your 9/11 story also.
We should do a 9/11 story probably in mid or late August, or
I think we should.
I'm not sure what day 9/11 is this year. I don't know.
Right. We'll figure it out so we can, because it's such a great story that everyone really should hear Kenny's story on that. But Kenny, thanks so much for joining us today.
Arusha, it's my pleasure. You know me, I love to talk, so I think this is great. I'm happy to come back and do it anytime you want.
So next week we are actually taking it off. So I want to wish Kenny, I want to wish everyone out there a Merry Christmas, a Happy Holidays, and of course a Happy New Year to all. And also, it's great to say so long to 2020. So that's it for this week on Investing with IBD. I'm Arusha Pierce, and thanks for listening.
And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.